I'd like to kind of cover a little bit of what we wanted to do, but I want to make sure that I give plenty of room for Brendan. So we're going to cover a little bit about what happened last year and how the economist that I hire sees things coming up, and a little bit of how we're going to organize our funds and the money for you. One of the things that Brendan brings to this is he works for one of the mutual funds that we use, and it's really like the most creative one of the mutual funds that we use. And he, of course, pays attention to economics and lots of things, but they actually have to manage money day to day. And they're right there in the trenches, and so that's really a different perspective. And so that's what he's going to bring today is like just what they do and how they see it. And it's a very refreshing, and you'll feel this is how my money is being managed. So I think I want to make sure that I save quite a bit of time for Brendan. So maybe I'll rush a little bit more than I usually do in some of my parts. Okay. So everybody has a book, and you can see the agenda that we have. So the last year was probably one of the greatest stock market years that we've seen, certainly in a long time. When I got in this business after my long career in Rockwell in the 90s, it was just going up every day. And I thought, why didn't I get into this before? This was just really good. And then we had 2000, and we just stayed flat really for about 13 years. Ups and downs and everything like that, but essentially the stock market was the same really in 2012 as it was in 2000. This year we really broke out, and I'm going to show you a couple of charts of the price earnings ratios and the Dow, which I think makes quite a bit of sense. But this year the Dow Jones Industrial Average was up 26.5%. The S&P 500 was up almost 30, and the NASDAQ was up 38%. So it's really an incredible run. Some of the things that took off this year, 3D printing, which a lot of the guys in here are in the printing business. And 3D printing is a whole different revolution in printing, making products by putting layers onto them. Solar powered stocks took off, and I put that purposely on there for you, Randy, to know that we are finally into new energy. And Facebook and Twitter soared to new heights. And so you're seeing like the change of the guard in companies, from the powerful old state companies to the new things. And really had a lot of IPOs this year. And probably next year, probably 2014, we'll have a lot of new entries to the marketplace too. Investors poured in $348 billion into stock mutual funds and ETFs, exchange traded funds, and on the equity side. So it was really quite amazing. Commodities didn't fare so well this year, and they were down for the year. Fixed income was a poor yielder. Interest rates have been at historic lows and are starting to rise. And so if you have some bonds that are paying 3% and they go to 4%, nobody wants your 3% bonds, they want the new ones. So if you held bonds, that wasn't a great place to be. So essentially, the bond index was down around 2%. Investors pulled out $72 billion out of bond mutual funds this year. The emerging markets was not that great a place to be, and so they declined around 4%. China's growth was 7.5%. India's was 5%. Those are really good numbers by us, but China was rolling along at 12% a year, and India was more like 8%. So those two areas were to be avoided. Europe came out of its recession and is experiencing slow growth. The stock market in Europe went up quite a bit, anticipating that things were getting better. So how do we see this year in 2014? BCA, which is the main economic report that I go by, indicates that easy money will continue, and that is very good for equities. And so they're recommending to be in equities this year, not in bonds, once again, similar to last year, although the pace of growth in equities would be a lot less. And Brandon will talk about that more in detail of the idiosyncrasies in the market. Economists have a much broader view than a guy in the trenches trading. The U.S. economy is expected to grow around 3 and 3.5%. So it had been growing around 2%, and 2% is roughly a break even. The number of people entering the marketplace, the new employees, are around 2%, and so you need to have that growth to absorb and keep unemployment where it is. And so you really need more than 2% if you want to expand. And so we've been in that break-even point, and so this year it looked like we were moving out of that, and that's how the confidence came back in the marketplace. And so it appears that the GDP in the United States will grow 3 to 3.5% in this year coming up, and that's why the Fed is going to stop buying bonds, because they think it's sustainable on itself. We don't need that extra stimulus, and that's why the stock market went up so much last year. However, really, most times when you come out of a recession, it's more like 4% or 4.5% growth, and so we've come out of this very slowly, and still not that rapid growth. So while we're in this phase of 3 to 3.5%, it should be much choppier and a lot more volatility this year than last year. But still a good economic view on things. The Euro area should improve, and as you remember, every time Spain or Greece sneezed and they had problems, our economy chugged along and maybe took a dive down. So that sort of thing should be improving this year. Abenomics that's the president. I'm not sure if he's called president or prime minister of Japan. Is it prime minister?
Prime minister.
Yes. So Abe is the prime minister, and they call the economic surge that's happening there Abenomics. And so they're really giving a tremendous amount of stimulus to their economy. And so we've given a lot of stimulus to ours, but they've given about 4 times more stimulus to theirs. So it's helping, but it's not necessarily solving the long-term problems. And so BCA feels that we'll have a surge for a few years, but they're not out of their problems yet. And, but they should get out of their deflationary position. China should still grow at 7 or 8%. They feel that China won't have this hard landing that a lot of people were looking at, and that they should have growth, but certainly not at the pace that it was at before. And government bonds are still pretty cheap, and interest rates will be increasing, and so that's not a good place to be when you're coming up. Commodities should bounce back, be somewhat stronger because the whole economy is growing. Currencies, the U.S. dollar probably will gain this year, and the U.S. dollar and the yen are probably going to drift a little bit lower, while the euro will gain, and the Chinese currency probably will strengthen this year. Hedge funds probably will underperform again. I don't know if any of you know much about hedge funds, but hedge funds take a lot more risk. And so they're liable to be into things that are not traded on the stock market, but are more like private things. And so they'll take more risk, and they get a 2% fee for that, and they get 20% of the profits that they make. So they're incentivized to really take a lot more risk. So people will invest with them if they've got the ability to take a lot of risk. And so those particular areas did not perform all that well last year, where the S&P 500 tech companies were the ones that performed very well. So you would be spending really a lot of money on a hedge fund and pretty poor performance last year, and probably will be the same again this year. Alternate investments like commercial real estate and those sorts of areas should have some interesting opportunities, and probably will show some value. It's very spotty though, and London and New York maybe is going to be poor value. So that's a little difficult area to get. The risks of East Asia and the Middle East, probably a little less because we don't have so much dependence on oil as we used to. And China probably represents a fair bit of military risk for us, because they're trying to claim a lot of the ocean around all of the Asian countries, not just along their borders, but through Indonesia and those particular areas. So we probably will have quite a bit of news about that during the year, particularly for those people who like to support military programs and military spendings. So how did we do last year? Well, if you were in our growth model, you made around 23%. If you were in the balance with growth, which is 70 to 80% equities, we made 16.42. Balance model 13, income model 5. And if you were in just all bonds, you made break even. And equities were definitely the place to be. We were a little bit less than the S&P 500, which is really always my goal, is to exceed that. But some areas we were just off a little bit. But still, really a perfect year. Our fund holdings last year, we had a fund called FMI, Large Cap, and that was up 30% this year. And what they do is they look for strong, durable trading companies, and they're patient and disciplined. And so when you look at, in your book, you've got detail on that particular fund, but when you look at that, all of the companies that they own are big, powerful companies that you recognize. And BlackRock equity dividend was up 24.35%, and it says 2007, but it was 2013. And they own large companies that are solid and pay good dividends. BlackRock is the largest equity company in the world, and they have offices everywhere. And so when I selected them, I really wanted us to be able to get dividend growth from all around the world. And so that's why I selected them. I thought they would be the best. FMI, the one on the top, these are all five-star funds, and they've been a five-star fund for a long time, and they are like sort of like the best place to be in a time like now. First Eagle Global is a fund that we really had a lot of experience with, and they're conservative, good investors, and their main portfolio manager is a Frenchman, and he's been terrific, and so he's been in the background, but he's kind of moved out of the key role, and other people are taking over. And I've actually been a little bit disappointed in this fund. It made 15.5%, but I'm disappointed into it. And so they convinced me that they were going to be just as good as the previous manager, but I'm ready to drop them for this year. So you're going to see a trade, and I'm going to drop them. They did okay, but I'm ready to move on with another one with a little more proven management. Mainstay Market Field, Brendan's company, 16.93%, off the S&P 500. He'll give you explanations, but they have a little different strategy. So they have a thesis of, they look from the economic view of where the profitability is, and then and where the best companies are, and then do tactical trading and get their investments. And so they're actually really terrific when you have a downturn, and not quite as terrific when you have a big surge like we have this year. Putnam Equity Spectrum Fund. So this is the highlight here. 44.55% gain in 2013. So I went to Putnam a few years ago. We've been in this for a while, and I think I'm sure I told you the story, but they had this analyst meeting, and I was attending these various meetings, and so I just had some time to spare, and I went in to look at this one, and the wholesaler that I was with, he said, "Do you happen to notice that these other portfolio managers that are in here have got their money in with this guy?" So I thought, geez, if the other guys who are investors think this guy's better, I better pay attention. And so his thesis is that he wanted to buy companies that had quite a bit of debt, like say like an airline. They cost a lot to buy planes, and so you have to leverage it. And so if you can get debt at 3 or 4%, and then you have a growing economy, this is like the perfect time to own leveraged companies. And so that was his specialty, and so this is like the perfect time. And I still think it's going to be a good time because that is going to be cheap for quite a while. So this is really a wonderful performance, and I think he'll outperform. Wasatch Small Cap Growth. So this is another great fund. And when you have a growth period, smaller companies usually do better than bigger companies. Not much in this case, but still pretty terrific, 31%. And we saw that the technology index, the NASDAQ, went up 38%. And so they didn't quite keep up with that, but they're safer. And really a well-run mutual fund company. And I was just at a conference and I met with those guys, and I'm going to tell you another fund here that I picked. So, Virtus Global Real Estate. So this one brought us down. This is why we didn't make the S&P 500. Virtus Global Real Estate lost 1%. And last year I was very convinced that real estate was going to be in a big boom. And so this company owns shopping centers, sort of big office complexes, and storage type units. Storage units did great. The other two areas did not. And so are we early to the party? And should you hang in there because maybe this is the year for that? But I decided that I was going to trade this company, this fund, and because it's just too specific, and it's just in real estate. So you're putting all your bet in real estate, even though we got a big variety of things. So I've got another couple funds that I'm going to show you later that I'm going to replace that with. Wasatch World Innovators. So this one made 33.7%. Great fund. And I think I told you the story last year, but Wasatch was founded by a fellow by the name of Sam Stewart, and he's a great investor and been running this fund family, founded it and runs the funds for 30 years. PhD, brilliant guy, and he's particularly specializes in small companies. So his son now is been a fund manager for about 10 years, and he said, Dad, I'd like to start a fund where we buy innovative companies like Apple, and they just very creative type companies that really got a lot of growth. So the father said, well, I'm the chairman now, and I really don't have much to do, so I'll be the co-manager with you. So I thought, boy, this is terrific. The young Turk and the wise sage. And obviously they came through with 33%. But the young Turk is not exactly a slouch. He studied at the Sorbonne, and he can speak Mandarin, and he knows really a lot about art history. He's an expert in that. So he's like, the apple didn't fall too far from the tree. Both pretty smart guys, but one with a little bit more experience than the other. So anyway, terrific funds. And in our income area, we had First Eagle Global Income Builder, and that was up 11%. And so we switched into that partway through the year, and I was pretty happy with that. Very conservative, good way to make income, making 11%, that was really great. The Putnam Diversified Income, we went into that, and I don't have the return on there, but it made about 7%. And so what they do is they buy high yield bonds, and then they hedge it by buying derivatives. So if interest rates go up, they're protected. And so what you really want in a bond is you want one that gives a fairly high yield, but really a short maturity. So that's impossible to have. And so how can you get something like that? You can buy a high yielding bond that pays about 7%, and then buy a derivative so that if the interest rates go up, it's protected on the downside. And so it effectively brought the duration of this to negative. So it's as if you had a CD. Maybe that's understating the risk, but you had like a bond, and you could sell it any day and get your money out of it, and you wouldn't you get your return. So that's what that one did. And the Putnam Absolute Return Fund did a similar sort of thing, except that it used corporate bonds with a little bit less risk. And so the return on this one is, the idea is it would give 5% over the inflation rate. This one would give 3% over the inflation rate. This one has less risk. And so that I thought was for people who wanted to be extra sure that they're still going to have their money. That was what we wanted to do. So Franklin Utilities didn't work out like I had in mind. So you're trying to get funds, investments that are going to give you a pretty good dividend rate and be safe. And the utilities really pay a nice dividend rate of about 5% or so, 4 or 5%. And I thought with housing going up, utility companies would have more volume and that would be a powerful thing. But it turned out that it wasn't really that great an idea because utilities traded like treasury bonds. So I'm gonna get out of that this year. Sometimes it just doesn't work out quite as well as we want to. The PIMCO total return was a similar sort of thing. We got out of that partway during the year, and that was a fund, the biggest bond fund in the world, and famous bond trader heading it up, Bill Gross, named bond king of the decade, but we lost 2%. Metropolitan West essentially broke even. So in the fixed income area, it was very difficult. And that's why you saw our return was about break even in that particular area. We got dividends and all, but the bonds and the utility funds went down. So we ended up having break even in that particular area. So I've got some better ideas, I think, for this year on that particular part. So I'm going to replace First Eagle with Thornburg Core Growth and replace the Virtus with the Oppenheimer Global Opportunities Funds. And so essentially getting rid of the First Eagle because the portfolio manager isn't there any longer, so you really don't have a track record to go by the new guys. And the Virtus was just too narrow a focus, and I wanted to have something with more of a global look at it. And I'm going to change the Putnam absolute return, which is we get 3% over inflation with the Putnam retirement income south. And so I'm rather thinking that we should be able to get like 6, 7% in that particular. It's a very big diversified way of doing fixed income. A little bit more risky, but I think it seems to be appropriate for this particular time. And then the Franklin Utility Fund will be replaced with a high yield bond fund, Federated High Yield Trust. And so I think those would be some great changes to your portfolio. Thornburg made 40% last year and can invest anywhere. This is really a great fund and much broader than we had with people. The Oppenheimer Global Opportunities, I think that your stocks are cheaper, and so there's more opportunity there. You have to be pretty selective of where you go. Probably some emerging market stocks that are pretty cheap now too, but Global Opportunities is another fund that I think is really terrific and should be better than where we were. The Putnam Retirement income made 9% last year, and so that was in a period of poor returns for bonds. So making 9% in that particular time, I thought was very good. And they're very prudent, and but they do have a mix of stocks and bonds into it. But the stocks are ones that pay a lot of dividends, and the fixed income are more on the high yield end. The integrated high yield trust made 12% last year, and it has a lot more high yield bonds and convertible securities, and uses duration to offset the risk. I think that should be a good place for us. So we had a terrific year, not perfect, but a terrific year, and I think the funds that we had that we're keeping are just excellent, and I think we're adding a few better ones than we had before to the mix. So I don't know what the returns will be, but I think we should be able to outperform what we got. So now I'd like to turn it over to Brendan, and you're going to get a different insight in. Mine is more of a global and letting these portfolio managers do their magic, and now you're going to hear what some of that magic is. Brendan.
Well, thank you for coming out tonight, especially on such a bad weather night. I work at Marketfield Asset Management. We're a relatively limited number of people, about 28, and we manage about $21 billion of investors' money, largely coming from the early stages of the RIA community. And I want to make one comment on the fund itself in terms of last year, the returns, and what Alan was saying about when stocks are up big, how we perform when stocks are down, how we perform. I think the best way to do it is to look over the life of the fund. We launched the fund in its first investments in U.S. stocks the day the stock market topped in 2007. Not necessarily the best day to start investing in the stock market, but because of the way we do what we do, over that time period, over the life of the fund, the S&P is up about 15%, and the fund is up about 82%.
Magda, please come to the first floor welcome desk, please. Magda.
So I hope that's somebody new. Last year's performance, we really do not look to try to bench ourselves against what the S&P 500 is doing on any particular year. If that were the case, then looking over the life of the fund, you would see what it returns. We view ourselves as being a total return fund and look to try to generate returns consistent with that of a successful operating business. We think that we ought to generate positive returns every year. That's what our goal is. So what I do want to do is talk about two things tonight. One, something that a lot of people are talking about over the course of the past 7 to 12 days. It's something that we've been talking about for a long time, and we're a little bit tired of talking about it now, but I'm going to address it. And then I want to talk about something that nobody is talking about, and something that we are thinking about that in the course of the next 2 years or so, more people are going to be interested in. And so what I want to talk about that everybody's all anxious about is emerging markets. Over the course of the last 10 years, the average number of stories in the news on a daily basis, average per day, is about 165 stories dealing with the topic of emerging markets. We have the technology to track this kind of stuff, and we monitor it. It's just one element of trying to get a sense of what are people consumed with, what are they anxious about. Over the last 6 days, those numbers of stories have spiked from that range of the average of 165 to 600 stories a day. That is a lot of ink for the financial press to spill on a single topic. But it is a topic that we have been spilling at the fund a lot of ink on over the course of the last 2.5 years that we have been short that sector. We have had a position of about 8 to 9% of the fund short emerging markets for 2.5 years. We spilled a lot of ink in April last year, and we spilled a lot of ink in December last year on the coming problems, or the problems that had been building, and suddenly there was a shift in focus of attention in the investment world to that particular sector. So now that everybody is consumed by it, the question then becomes, now we're getting a lot of questions. Okay, now what? And the other thing that I will say, Alan does have access to daily and weekly commentary that we put out, and Sincere and Company, which is our third-party marketer, catalogs that entire history of daily and weekly commentary going back for 6.5 years since inception of the fund, so that our record is not quote-unquote public, but it is available to the RIA community, who are our clients, to see what our written track record has been. And our goal is to try to be as transparent as we can be. We don't want to be a black box where money gets put in and then at the end of the quarter we sort of tell you what the numbers are. We, on a daily basis, are communicating 2 to 3, maybe 4 sometimes if it's a busy day, commentary on economic data that's coming out and how it either ratifies or might be running against one of the themes that we're running, and tries to just be in real time as reflective as we possibly can be to the RIAs, so they know what our thinking is, and they know if and or to the extent that we're be changing our thinking about what's going on. So emerging markets right now that it's a hot topic and on everybody's radar, the 2 countries that really sort of got everybody's attention in the last couple of weeks were Turkey and Argentina. We suggested in the spring of last year that we were on the cusp of a mini currency crisis, and that sort of got going in May and June of last year, and then in December we said the thing that's going to derail U.S. stocks and developed market stocks, European stocks, Japanese stocks, is probably going to emanate from the emerging markets, and it's probably going to emanate from currencies. And so those currencies are really, gotten extremely weak over the course of the last 2 to 3 weeks. But what is a little bit concerning right now is not the typical culprits that everybody's looking at. We're looking at Turkey and Argentina because they had sort of moved the most. And the way we're looking at it as that now that it is spread to the Russian ruble, which does not have the same sort of economic problems that the other weakening currencies do, like Turkey and Argentina and Brazil and India. Russia does not have a government deficit. They don't have a trade. They don't have a current account deficit the way these others do. The fact that it is sort of spread into a country that has a little bit more substance to it, it doesn't really have the same problems. We're likening that as being akin to when Greece and Portugal were suffering their problems in the European debt crisis, and it started to kind of spread into countries like, we all know the names of the countries, but Greece and Portugal are quite small. Argentina and Turkey are quite small. But as it started to spread in, the European crisis started to spread into, say, Spain and Italy and eventually France, it wasn't the particular countries that were showing the weakness, it was the number of countries that were showing the weakness, and it was spreading into those a little bit more substantive economies. And so the spread to Russia, we are more focused on Russia right now as being sort of a bellwether as to whether this evolves into something more than just a panic. And Alan was saying, that we published this book here recently, and basically I wrote a book. It sprung out of a class I teach at the Owen Graduate School at Vanderbilt University. I teach the executive MBA program in the weekends in the fall, and then I teach all year round on Monday nights. I don't know why I agreed to do that, but I did. It's my give back. At the undergraduate school, I teach the investment analysis course to the undergraduates. So at the graduate school, as part of the course I teach there is a global macro course, which is of course what we do at the fund, we're macro, is that I take the financial crisis in the U.S. from 1792 into the present and try to identify, is there a single strand that you can connect all of these problems and issues with? And lo and behold, you can't. I mean, the name of the book is, the title of the book is Next Time Will Be Different, Why Economists Can't Predict Financial Panics and Crises. And it's really a little bit of a swipe at some of my colleagues, a couple of whom put out a book recently called This Time Is Different, 8 Centuries of Financial Folly, as though they had good data for 8 centuries. And I noticed that their book came out after the financial crisis, not before the financial crisis, which makes me a little bit, circumspect about their observations. But in the process of putting that course together, I went through and kind of made this analysis, went through the different crises, put it in the book, I teach it in the class. But the distinction I want to make is that the difference between a panic and a crisis is it's a little bit subtle. In a panic, you basically have sort of a psychological event where people get very nervous, and for reasons they can't necessarily articulate or explain, they just start selling securities. You've seen this on a micro basis. I spent a year on the bottom floor. I was too small. I couldn't stay there, so I had to go upstairs. I worked for Pete Stottlemyre. Do you remember Pete?
Yeah.
Right, so I worked for Pete in '87 and '88. So our circle was crossed in terms of colleagues those years ago. But this phenomenon affects on a very short-term basis, but also on a very long-term basis. And my point is that in a panic, you're dealing with a situation of illiquidity and people rushing to try to get out of something. And basically, the central bank and the institutions can sort of handle that problem by themselves. It's not the end of the world. The flip over to a crisis is, rather than illiquidity, where people have to get out of positions because they have margin calls or they're afraid their securities are going to go lower, so they just want to rush out. I mean, it's not like they have to do it, they're just concerned, so they get out of it. It helps push prices down. The distinction between a panic and a situation of illiquidity and a crisis is one of insolvency. We have firms that are literally insolvent, unable to pay their bills. And that is the situation right now, I think you're starting to see in some of the emerging markets. The headwinds they've been facing over the last several years have been a little bit sort of brushed over by the amount of foreign capital that's flooded into those countries to help plug their current account deficits. They need capital to plug the amount that they're buying more from overseas than they're selling overseas. The influx of foreign capital in their bond and currency markets has helped sort of ameliorate that situation, sort of paper it over. As soon as Ben Bernanke on May 22nd last year uttered the word taper, it created rumblings in emerging markets. The MSCI Emerging Market Index went from 1048 on May 22nd when he uttered that to 877 on June 28th. Subsequently rose as the Fed sort of kind of backed off that a little bit going into September. The Fed didn't taper, and everybody was like, oh, okay, maybe the Fed's not. They sort of caught the market flat-footed a little bit. If you look what that emerging market index did, it went back exactly, actually 1 point below. The price that prevailed on May 22nd when he first said the word taper. And foreign investors collectively, without texting each other, or emailing each other, or writing each other, realized we are not going to pay more for emerging market stocks on September 22nd than prevailed on May 22nd when he first said taper, and that was it. And now EM is really starting to go down. And the hidden element of EM, I believe, is in the currencies. Because the currencies have weakened so much, if you consider that you own foreign stocks, you're seeing those stocks and you're seeing an index of those stocks kind of going down. But were you to sell that, and that product had to sell the securities, and then translate it into the currency is now that much lower, find a 10% lower, that the translation is going to be even more significant than people are realizing. But it's sort of a hidden loss in that transaction. It would take actually execute the transaction to get people to think about it. So, like I said, it's a position we've been short for about 2.5 years. It's not a huge part of the fund, but it's about 9% of the fund. And under EM drops, then it gets a little bit larger part of the fund. That is a topic that everybody's talking about, and we suspect that it probably gets a little bit uglier before things really resolve themselves. The price going down is not going to fix the problem. The problems are at the governmental level and policy level in the countries. Until that changes, the pressure will be there on those markets. As the currencies weaken, the central banks raise interest rates to try to keep the currencies from weakening, and that puts pressure on the domestic companies' interest costs. Anytime they go to roll something over, they're now dealing with higher interest costs. And this started in April and May. It's just now starting to affect the economy from that action. The most recent rate hikes won't affect the economy for another 4, 5, 6 months. So there's still additional pressure there that is going to get to be resolved, and we think there'll be lower prices in emerging markets. The topic that nobody is talking about, more to the extent that the term is used, we think it's being used in a very broad way, is inflation. And that is that for the first time in my memory, I mean, I've been doing this for about 26 years, and I have a little bit of vicarious experience going back, from my reading going back even decades or a couple of hundred years. That you have central banks actually saying, we want some inflation. Central bankers are not noted for saying that. Central bankers are noted for being stodgy, cigar smoking, they got that from Paul Volcker, inflation fighting, old, fat, white men. That's just kind of the way it is. They don't like inflation. But suddenly, central banks of the world are saying, we need a little inflation. The suspicion is they're probably going to get it. And they're probably going to get it in a way that surprises them. It'll come from an area that surprises them. Hence, next time will be different. It's not going to come the typical kind of conventional way. And we think there are several forces starting to coalesce at the economy. I mean at the macro level, the constellational level. If I can come off the globe and go to space, and by that I mean, if you go back to the 1960s, basically the United States was running two wars. We were fighting a foreign war in Vietnam and a domestic war on poverty here in the United States. And the way the government decided to finance that was that they just printed dollar bills. And the U.S. could get away with that because the U.S. dollar was tied to the value of gold from, in World War II, fixed at $35 an ounce. By the way, during that Bretton Woods period from 1946 to 1971, there were no financial panics or crises in the United States. None. I'm not advocating we go back to Bretton Woods. I'm saying from 1792 to 1934, we were on a metallic money era. The money was metal. It was not paper. From 46, during the war period, it was all everywhere. From 46 to 71, we're on the gold standard, gold exchange standard. From 71 to now, we're on a paper money standard, a fiat paper money standard. So the conversation in the 60s was sort of inflationary. The idea that we can print money and solve our problems. We can print money and draw bonds. We can print money and pay for social programs. And the dollar was pegged to gold, so it really sort of papered it over. Until August 15th, 1971, when Nixon let it go, that was it. That was the beginning of the emergence of inflation. And it accelerated in 1973 with the Arab oil embargo. After the Six-Day War, Israel went in and basically put the other regional powers to shame and said, don't mess with us, we're not going to do this. That was the Arab oil embargo. And at that time, 1973, Congress basically passed a law and said, the United States cannot ship oil out of the U.S. Whatever oil we produce, we cannot send out. So that's still in effect, and it's playing a role in kind of the energy renaissance that's going on right now. But that's a story for another day. What I want to focus on is that the cheap oil that was a lot of the engine of growth in the U.S. economy in the 60s and the 70s, and it did end in September 1971. OPEC had their own meetings, and they came out and they said on September 9th, they said, and that was September 9th is my birthday. I wasn't born in 71. Well, yeah, I was born in 71. That's about right. No, I mean, the reason I remember it is because my birthday is September 9th, which is California's mission day of the Union. OPEC came out and said, because you have severed the link of the dollar to gold, we're going to raise the price of oil to retain our purchasing power. They started that in 71. And then with the oil embargo of 73, it basically put the U.S. on its back foot and really created problems for a large manufacturing, industrial-based economy that needed cheap energy to do what it did. Okay? This potential emergent cycle of inflation is not going to come from the oil sector. It's more likely going to come from the inflation that has been seen in China in wages, where now Indianapolis, Indiana, and Austin, Texas beat out about 5 cities in China in terms of being a cheaper city to manufacture in. Because wages have gotten really high in China on a relative basis over the course of the last 10 years. Kind of unnoticed, sort of incipient, kind of quiet, but a number of manufacturing firms are starting to move manufacturing back to the U.S. Apple's making a commitment. And it's not just, goodwill or generosity. They're not just saying, well, we're going to do this, we're going to do it at a loss, we're going to do it to placate the American public. They're not doing it because of that. They're doing it because it actually is cheaper to bring it back over here. The energy renaissance going in the U.S. is actually feeding that. Actually, our favorite emerging market country is the center part of the United States, actually. And so we're dissecting states of origin for companies that are doing business in these particular areas to see if there's a way for us to benefit and capitalize on that. But when we first developed the inflation thing, we shorted a number of stocks in May of last year. This is not headline CPI is going to go through the roof. This is, there are going to be emerging pressures in certain commodities and certain industries that are subject to casual labor that do not have labor contracts that lock them into a fixed price for a certain period of time. And that those companies are going to feel margin compressions. Those companies are going to have to pay higher costs for their input and pay higher costs for their labor, so the profits are going to go down. And so we've tried to identify where we think the emergent sectors are in this quote-unquote cycle of inflation, which won't materialize in the headline numbers for a long time. CPI is 600 items in a basket, which is a really big basket if you think about it. That's not what we're talking about. We're trying to isolate where it's going to kind of bubble up from. And then, so we did that. We put some of the positions on. 3 weeks later, McDonald's came out, and nationwide there was a flash walkout. Employees walked out of McDonald's last year and said, we want to raise what our minimum wage is. The next week, the franchisees came up and said, we no longer want a dollar value menu, we want a $5 value menu. Well, that is a little bit of an emergent sign of the inflationary conversation. Other examples, the State of the Union speech, to the extent that federal contractors are now going to get $10.10 an hour. 21 states in the United States have a minimum wage higher than the federal minimum wage. Anybody who pays attention a little bit to New York politics, I have to, I'm a consultant to the editor-in-chief of Bloomberg News, and Mike Bloomberg just left the mayor's office and came back to the Bloomberg headquarters, and now de Blasio is now mayor, and he ran on a platform of, tax the wealthy. The populist conversation echoed what went on in the State of the Union. It is starting to become a little bit incipient in the economy, getting this pressure. Now, the real thing in terms of a turning point is, if you look at corporate profits as a percentage of U.S. GDP, it's about 12%, 12.5%. It's a record high. If you look at wages and salaries as a percentage of GDP companies pay out, it's at about a 40-year low. So you've got this tension between the extremities of whatever the terms are. It could be, and it may have actually gotten its start in the Occupy Wall Street movement, which was sort of flashed and then kind of went away, but first they were mad at bankers, and then I think they changed they couldn't agree on what they were upset about, but I mean, I think it eventually got around to like inequality just in general. But the income gap or the wealth gap or whatever, it is just language that is starting to become more conversational. And the question then becomes, has labor gotten to the extremity of point on the downside that they start to manage to wrestle a little bit of power to come back? Because that inflation is not just the fact that the Federal Reserve creates money. That was what everybody fixated on in 2008. The Fed came out and said, we're going to pump money into the system to try to ameliorate this problem. And the Fed, everybody started quoting Milton Friedman, inflation is always and everywhere a monetary phenomenon. If you go back and read in that section, right after that he goes, but it can take a very long time. So the money has been filtered into the system. To some extent it has percolated and emanated up into the financial system. But you're starting to stretch, I think, the tension on the labor side to where you might start to have them start to wrestle power. So we're monitoring that. In 15 industries that we break down from data from the Bureau of Labor Statistics, which is not, it's not widely circulated. I don't know why people don't pay attention to this, but we're not advertising it. We're happy to look at it on our own and nobody pay attention to it. In 11 out of those 15 industries, wages are now rising faster on a year-over-year basis than CPI is, general measure of inflation. So there's the beginning stages of that phenomenon. And like I said, we don't think that it shows up in CPI. We don't think this is big headline economic data. We think that it shows up in select pockets of industry, and we're trying to identify what those pockets are, which companies will suffer as a result of it, and which ones might, fewer of them, benefit from it. And then that's just one of the 8 or 9 things that we're running in the portfolio now. So EM is something everybody's interested in, and we're a little bit tired of talking about because we've been doing it for 2.5 years. Inflation is something we're interested in talking about, and we think that in 2.5 years people will be interested in talking about it too, and that's when they'll call us and we'll be tired of talking about that, and we'll be talking about something else. So with that, I'm happy to open it up to any questions, either on this topic or any other topic. Between my brother and me, we know everything, so go ahead, ask. Yes?
You know, it's interesting, you talked about the big countries, you know, Portugal, Italy, Greece, Spain, and they were tourism-based. So as the euro strengthened, their tourism dropped, then their socialism put them in trouble. Then it migrated through Europe, and we saw that run. Now we've got Russia, whose basic economy is based on oil. And the fracking that we're doing in the United States is driving the price of oil down. In the North Sea oil, which takes care of Scandinavia and England, also is there. But you see a similar parallel happening, that as we're successful and become energy independent in the United States, that we're going to see the equal and opposite reaction of these other oil-dependent countries suffering.
I usually like want a question that's like a little bit punctuated. I say, oh, that's what my brother knows. You have to ask me something else. That's actually one that I'm happy to. I'm trying to get a laugh out of the audience, but no. Well, and the reason I went to some pains to say since 1973 we've not been allowed to export oil is because there will be a geopolitical shift in the world because of the growing energy independence in the United States. And it's not just the fracking, it's not just our favorite EM country being in the middle part of the United States, and it's not just the shift to us using more natural gas. It is going to, in all likelihood, add to political instability and turmoil in the Middle East. I have said since my son was in 5th grade and he made me come into a little public school, had a little TV station, and I was just sitting, I was kind of consulting from home at the time, and he wanted me to come in and like speak on the show. And I don't know what made me think I could say this to 5th graders, but I did. It was like, the world will never run out of oil. I guarantee it. It won't. Because somewhere in the US, or maybe Germany or Japan, there's some 20-year-old doing for alternative energy what Zuckerberg did for, people wanting to have, instead of a phone book, I guess that's what, instead of a phone book, it's a Facebook, right? Is that what it is? I never really understood it. My 11-year-old didn't even know there was such thing as a phone book. He thought you got phone numbers from people calling. He didn't know there was white pages. Somebody will figure out a way to get around the internal combustion engine. The other reason we'll never run out of oil is because the cost of getting that last barrel out of the ground is not going to be worth whatever you can sell it for on the other side. They'll stay there. The Middle East will choke on its last barrel of oil before it's all done with. And that is, to some extent, problematic. And to the extent that we're able to produce more oil here in the US, we are still not allowed to export it. So you're getting that widening spread between WTI and North Sea oil, Brent oil. That oil has to stay here. So it piles up at Cushing, Oklahoma. It doesn't have anywhere to go. They put it on barges. They put it. We're allowed to send a little bit to Canada. That's it. So we're the ones that are going to really benefit from the thing. We've gone basically from 30% to 15% of our independence in the last 5 years. And, you know, EIA projects that it's going to be a little bit more in that direction. And you have more and more people who say it's going to, you know, it's going to be down to like maybe 5% over the course of the next 10 years. And if that's the case, I mean, think about, you know, the involvement of the U.S. in the Middle East for as long as we've been involved in the Middle East. And those concessions were started in 1937 when the Seven Sisters, the 7 U.S. oil companies, went into Saudi Arabia. Ibn Saud could carry Saudi Arabia's treasury around on the back of a camel. And they signed 70-year concessions, which they broke in the 60s. Now, the federal government here didn't want to say, wait a minute, this was a contract. I mean, how do you impose that on a foreign country, right? But the ability to disengage from those parts of the world is going to be heightened because of the renaissance that's going on in energy here in the U.S. The caveat I'd stick in here, because I'm trying to think it forward, I'm always trying to think forward, you know, 2 or 3 minutes on the chessboard, is that to the extent that we do lower the price of oil, it reduces the incentives for that kid sitting in that garage to find out the answer. Best thing that happened in the United States is having oil go to $100. And I've got a guy named Bob Brennan in New York who will, I mean, I used to travel the world with him for Bloomberg. In 2002, I told him, I said, the best thing that can happen to us is have oil go to $100 a barrel. Because it will provide the incentives for us to start to break from this dependence on foreign oil. And what has it done? There were no electric cars in 2002. Now, I didn't predict, okay, there are going to be electric cars. I'm just saying you need that high price to create that incentive. So the Renaissance is great because it's only the price. I want it to stay high enough to provide the incentive for the Zuckerberg of energy to kind of get it figured out. And I'm not that guy. I mean, I don't know what that is. But there's some guy or girl who's going to figure this thing out. And that means that all the cars we drove over here today, the value of them is going to go to, you know, artwork. I mean, or museum work, or zero, or whatever. Anyone else? And not everybody all at once. Well, you don't have to get rid of it. You just won't be driving around so much, right? Well, look, AM radio never went away. The cars, I mean, you know what? And maybe it'll go in, you know, 50 years or something. Or go, look, think about how innovative Cubans have been at keeping 1950s cars running. And they can't import anything from here to make it happen. And then, talk about clever. I mean, it's pretty clever. Yes?
This has been my theory that inflation wouldn't go up that much when China was such a big competitor, and you couldn't really increase your wages because you could buy it over there. And what you're saying that
Is that China is the oil of the 70s here. The increased pressures of inflation in China are akin to the increase in oil prices as a fuel for the engine of the U.S. economy. 1990, I bought my wife a sewing machine, $800. It cost more than the motorcycle I bought. The motorcycle was only $750, and that was my transportation. That's how I got around. Her sewing machine cost more than a motorcycle, okay? Well, within 10 years, she was like, there's no sense in me even making this stuff anymore. She like make curtains or make stuff for the kids or whatever. She's like, it's cheaper for me to just buy it and then, like, when they have it broke, just throw it away or something, because it's just always so cheap. And you're right. The analogy I was trying to make is the cheap oil of the 70s, getting that shock is the cheap inputs coming from China going to, I think, fuel this. I mean, just anecdotally, I have to think about where I am. I'm sorry, I travel to so many cities, I really have to wake up in a hotel room, I'm like, where am I? Where am I? I'm in Chicago. Northwestern football, my son's at Northwestern, the football quarterback was to unionize the sports players. Now, you might think, that's got nothing to do with inflation. It is part of the conversation. Inflation becomes a problem when, look, the Fed pumps money into the system. If it stays in banks or goes into financial assets, it doesn't work its way into the real economy. If and or to the extent and the way it works itself into the real economy, and you get it coupled with wage strength, you get that spiral. You get, this is costing more, I want the higher price. They pay it. Here's one of the reasons why you're going to get those constraints in labor. You think, Brendan, it's impossible. You have unemployment at 6.7% in the United States. All these people out of work. Net migration to the United States for the last 3 years is negative. Okay? So the people who are picking tomatoes out in California, or picking kale out in California, I now have to replace with a Stanford graduate who's going to work 6 hours and then want a coffee break and then come back and maybe pick a little bit more. Completely different from the migrant labor that I was using before. The other thing that people are forgetting about this whole employment picture is that in each expansion in the United States since World War II, you have an expansion, and employment goes up and up and up and up, and then you get this sharp layoffs, and you get a slight drawdown in the amount of people unemployed. In the expansion from 2000 to 2007, 2001 to 2007, we created about 6.5 million jobs. In the recession, we lost 6.3 million. The first time since the Great Depression, we wiped out more jobs in a recession than we created in the previous. The thing is, those people are largely still out of work. They've been out of work so long, they don't have the skill set to come back in. So you turn to me and you say, unemployment is 6.7%. It is not the same this time. None of these things are the same. Those people are not employable. They do not have the skill set. They've been out of work for so long, and getting the government subsidies, this is not a political conversation. It's that they don't have anything they can do productive back in this economy that's going to bring them back in. And yet, the economy is bigger than it was before, public profits are higher than they were before, stocks are doing what they're doing, that's great, I get it. But those people are not coming back into the economy. They don't have the skill set. Now, could they go and train themselves and educate themselves and so on? Yes, to some extent, but to the extent that they are, 55 or whatever, it's less likely that's going to happen. So you really have sort of you have a shroud over potential artificial tightness in the labor market in the U.S. economy. And to the extent that you never have this stretch of corporate profits at 12.5 and wages and salaries at 48.5, I realize those are, I'm just saying they're almost record extremes. I mean, obviously, one's more than the other, but you have this sort of record tension. The convergence of that coming back is what starts to create that spiral. And the beginning cycle of inflation is not CPI going up next month or next quarter or a year from now. It is, it'll materialize in incipient parts of the economy, and our job and challenge is to try to find those to benefit from it. And then, in 2.5 years, the number of stories talking about, inflation will have gone from 165 to 600 or whatever, and people want to talk to us about it, and we won't be as interested in it. I suspect we won't be as interested in that, just like we're not as interested in talking about EM right now. So that might have been a long way around.
You got any feel on the stock market?
Well, I think that like you said, last year was, and I'll be honest, we can go back and look. Michael Shaw, the chairman, in March, April last year was saying, this could easily be, a melt up 30% year in U.S. stocks. We don't try to replicate the S&P 500. If we were trying to do that, we'd be up 15% over the last 7 years. We don't do that. Instead, we're up 82% because we're not trying to replicate the S&P 500. So this is going to be a year that I think starts to separate, I mean, you know, the grown-ups from the not grown-ups. It is going to be a bit of a more difficult year. And, you know, I think one of the really interesting things, this is one of the exercises I gave the great fun of doing this for a living and then working with some of the younger minds in university is trying to keep them current on what's going on, give them exercises and assignments that will keep them current on what's happening, so when they go into interviews, they're not just getting a professor saying, here's what it says in the book. I'm trying to arm them with what they need for, you know, going and talking to prospective employers. But the assignment I gave them the other day was reinforced this morning on a phone call with the CEO of our fund, which is, you know, housing is basically up 1%, you know, on the year. Stocks are down 3%. Okay. Housing has been sort of kind of grinding sideways here a little bit. It's a position we've had for the better part of 3.5 years. And the final stage is yet to unfold in housing. The investment cycle always leads the economic cycle. Every recession since World War II, the U.S. economy has come out of because of construction, residential and commercial. It's the one element in economic data that has not resumed to its previous sort of normal path of what's going on. And we believe that construction cycle is going to start to happen. It's going to start to happen with you know, a pretty good vengeance. So the fact that housing is unchanged now while the S&P is down 3% is an early sign to us that that's going to be the sector that starts to lead back up here on the way out. It sort of switched hands with retail going back 2 years. Retail kind of led it here recently, and retail is the quickest to break down now. Housing has really held in there, so I think housing is going to do it. We don't look out and say, here's what we think the S&P is going to be next year. It's just not what we do. And we don't invest in sectors. In housing, we don't just invest in home builders. We're like, okay, there's some home builders, Sherwin-Williams, regional banks that really depend on mortgages. So now you've got an array, right, of somewhat uncorrelated, yet somewhat diversified companies on the same idea that are going to benefit without being a home building thing. Rather, it's what is the spectrum that is likely to benefit from this idea. So this is going to be a little bit more difficult year, but you know, there was actually, so the Financial Times interviewed Michael Arenstein, who's the portfolio manager charged with responsibility of the fund. And I can tell you, I've known him for 14 years, and I have a selectively eidetic memory. I can remember certain things with perfect clarity. And you ask my wife, she'll say, now, I told you last week that we had that. I'm like, I have no recollection of that. I don't know what you're talking about. And I'm not doing it on purpose. It just goes in one ear and out the other. But in the FT, the Financial Times interview with Michael Arenstein, you know, he said, last year was an easy year, and I am drawn to complexity. He has, on 3 occasions, said, I am drawn to complexity to me over the course of the last 14 years I've known him. It is the way he sees the world. That is the way he characterizes the way he sees the world. He comes at it from one angle, Michael Shull comes at it from another angle, and I come at it from a different angle. And the idea is, through advice and consent and advice and dissent, Arenstein is charged with making decisions, but this is going to be a more difficult year, but it's probably going to be a better year for us because of that. And that doesn't bother us really. The year when, like, you know, anybody can make money because it was up 30% is the old Wall Street adage, don't confuse brains with a bull market, right? I mean, you have a 30% run, it's like, okay, we all make money, right? Now comes, you know, part of the challenge. It's going to get a little bit more bifurcated, and we think that we've identified, and these things are not independent. They're not like, oh, here's an idea and there's an idea. They fit together a bit like a puzzle. And a lot of the things that are affecting one are going to affect the other. For example, the money rushing out of emerging markets where we're short, we think is moving into Europe. We started buying Europe a year ago at the periphery and moved more into the core. We started buying periphery Europe 2 years ago, and it started moving more to the core last May. And so we think the money coming out of EM is actually moving into Europe. So we're 9% short EM, 26% long Europe. We think those are actually reinforcing each other. The same dynamics that are affecting one in a negative way are affecting the other one in a positive way. So we think that last year there were a lot of people who tried to go like this, and it's probably going to be a little bit harder to do that come January next year. Yes.
Do you have a feel for how fast the Trans-Pacific Partnership might affect the market?
The
Trans-Pacific Partnership.
Well, I think that taking narrow sort of economic slices that try and extrapolate it out to the rest of the overall market is a bit of a stretch. For example, you would think that strong GDP growth would correlate with strong stock market performance. Instead, the economy growing, we all look for good GDP numbers, right? If it's growing, then it ought to be good for corporate profits and so on. Okay? Economics would suggest that's the case. But if you look at the correlation coefficient, which is basically what is the degree on a scale of -1, which means they move exactly opposite each other in the same percentages. That's one end of the scale. The other scale is +1. They move exactly the same. They're moving in lockstep with each other. So in putting together a portfolio, we're trying to find non-correlated assets. We're trying to find things that are down toward the 0.2 and the 0 so that you own an umbrella company and you own a sunglasses company so that you're not all one way, right? The correlation coefficient between GDP growth and stock market returns since 1946 is 0.12. They are uncorrelated. If you say, well, the stock market should lead the economy, I'll agree. The correlation coefficient on a lag, if you say, well, what did the stock market do first, and then what did GDP do? Because stocks should lead the way. Correlation coefficient is about 0.2 on a 1-month lag. If you do a 2-month lag, GDP is reported on a quarterly basis. So if I do a 2-month lag, the correlation is actually -0.2. So there isn't really this grand, seamless connection between what the economy is doing on a piece of legislation or any kind of hacks that we're going to open up. Now, on individual company basis, that's where we get the analysts from the bottom up and start to say, okay, which particular companies are going to likely that or have contacts there or are already doing business there or can get contracts there. But from a macro view, I don't see the connection. I'll give you another example. All the quantitative easing programs put out by the Fed. Pop quiz. I'm putting the professor hat on now. So the Fed was going to buy all these bonds and treasury bonds and mortgage-backed bonds in an attempt to do what? Or what were they trying to do with this? What was the end game? What was the goal? What were they trying to manipulate? What price?
Long-term interest rates.
They're trying to affect long-term interest rates. They're trying to push, by buying bonds, they push long-term interest rates down. Splitting it between treasuries and mortgages. Mortgage, they really wanted to affect that mortgage market, so they kind of had to split about $40 billion there and $45 billion in treasuries. That makes eminent economics 101 sense. But if you take the 10-year treasury yield and you plot it from 2007, August 9th, 2007, when the subprime crisis started, when BNP froze 2 mortgage-backed funds because they couldn't value the securities, and you come forward to 2008 when the Fed started its programs, and you put vertical bars and say, well, this was the time period of QE1, And this was the time period of QE2, and this is the time period of QE3. Interest rates rose in each of those episodes. And since the Fed started tapering in December, interest rates have dropped. It's the complete opposite of what the economics textbooks says is supposed to happen. So now, what is the takeaway on that? Our takeaway is, don't believe everything you read, don't believe everything you hear. Open the hood, look under there, and see what's really going on. Just because the Fed says it to try to do it, because an economist who's never managed money before is a tenured weatherman. You can get the weather wrong, still have a job, right? Then I want to look under the hood and see what's actually going on. And so that's just an example of, that's what we do. We try to peel back the onion and say, what is really happening, rather than, well, that's what's supposed to happen, that's what everybody says is happening, and therefore, that's the, and then we try to see, what does it say about where people are positioned? What does it say about what people believe? Is this an over-owned asset? I mean, we were short a safe haven theme that had 3 very unlikely candidates. And this was the case last year, too. I mean, we'd covered one of the positions by the time we had this meeting, but bonds, Apple, and gold, we believe, were basically the safe haven trades in 2011 and 2012. And we were short those positions. And one by one, those markets have gone by the wayside. Since our meeting last year, we'd already gotten out of Apple because the drop was so precipitous and so fast from September through November. We had our meeting in January. So there were 3 legs to this stool: bonds, Apple, and gold. Apple went first. April 12th and April 15th of last year, gold dropped. Biggest 2-day decline since 1981. It basically came unglued. I mean, you went from 1684 to 1200. It did eventually get down to 1180, but it did that over the span. I mean, it dropped $68 on April 12th, and it dropped $143 on April 15th. And then bonds started coming unglued in June. And everybody said, bonds are coming unglued because of the Treasury, because the Fed's talking about taper. No, you have the logic wrong. The Fed's tapering because the economy is looking better, and that's why interest rates are going up. It's not because the Fed says they're going to stop doing this. They have it, kind of backwards in terms of that logic stream. So anyway, I'm loath to try to take that one big thing and say, what's that mean for the stock market? I say it means something for some individual stocks. And I'd probably go to analysts and say, okay, let's take this from the bottom up and try to see, are there individual companies or industries that have to benefit? I don't think that it's that big a deal on a $20 trillion stock market. So. I've worn you out.
I think it's time for dessert.
Okay. All right, good.
Okay. One comment I wanted to make is we go with this little look at the Dow, and just 30 companies of the Dow, and currently, and the forward price earnings ratio is around 14.1, and normally it's like 16.5 or so. So the market is not overpriced, and then the projection for earnings going out looks pretty decent. And so in 15, the price earnings ratio would be like 12. So I think that there's still lots of room for the stock market to grow, and maybe not as easy as it
Well,
was.
it's going to be more difficult. And the other thing I'd add is, if you look, typically what happens at the end of a bull market is that one sector, one idea captures the imagination of the investing public, and they go crazy over it, okay? So, just for example, in 2000, the tech sector was 35% of the S&P 500. Out of the 10 industries, tech was more than a third of the entire industry, of the entire index. In 2007, financials were 25%. Today, there's no sector that's more than 20%. So this has been a fairly evenly distributed and kind of balanced move in equities. You don't yet have that sort of mania or captivated everybody's attention or they're throwing the reason to the wind. The fact that it's fairly balanced, the fact that EM is causing disruptions in the U.S. market is not a surprise to us. It's not a big deal. We don't really think it's a big deal. And we're perfectly happy that the market is balanced in its ascent, rather than being led just by tech or just by financials, which you don't want. You don't want it to be led by just that one area. So, all right, is there time?
Okay. Thank you very
Right,
much, Fred.
thanks.
Appreciate it.